Now, let's try to understand different kinds of mechanisms or the methods which are more and more appropriate to evaluating the capital projects. The intention being, whatever is the initial evaluation which we are doing, using these various evaluation methods, I am trying to look at what kind of decision I have to take in terms of undertaking the project. All these mechanisms are targeted towards helping me in terms of taking a decision with respect to whether a particular project needs to be undertaken or not, whether the project is feasible or not. So that is what goes as a part of the understanding of different models. Wherever the numericals are there, we'll try to handle them as a part of the separate session. But first, let's try to understand the conceptual aspects that go into the understanding of each of them. And wherever the formulas are there, let's try to understand the formulas that are driving them. The first most important tool is the net present value, in short called as NPV. And what this method says is, okay, today I have invested something in the project. Let me call it as CF0, cash flow that is invested at time point 0. And let's say from period 1, period 2, period 3, so on, period n, this project is going to give me a net cash flows of these numbers. So net means during that period I am looking at the revenues and the expenses without considering the finance costs, without considering the depreciation, anything relating to the financing I am not considering, and this is what is the net cash flow that I am getting. So whatever is the net cash flow, I am looking at each of these years that I am getting and trying to bring them to the present value by discounting it with the appropriate discounting rate. I discount all of them with the appropriate discounting rate, sum up all these cash flows, and this is what I am calling as the net present value of the particular project. So it is modeling all the cash flows. So here this is an estimated cash flow. These are not actuals because we don't have any understanding about the actuals. So estimated cash flows for the project until the termination. Probably this project is an n-year project. So the termination period is n years. And all of them I am discounting it by using an appropriate discount rate. I am finding the present value of all the cash flows, and this discounting rate, in some cases we also call it as the cost of capital, or in much more a better sophisticated sense, I also call it as weighted average cost of capital. The capital and the cost that is associated with the different sources of capital to execute this particular project. And the simple interpretation is, if the result is positive, I'll accept the project because I will be of the feeling that it will improve the shareholders' return. So, because these are all expected cash flows, we will try to see a range of scenarios for different cash flows. We'll try to visualize different kinds of possibilities for different kinds of scenarios, wherein I will try to visualize what would be the cash flows in each of these different possibilities and try to get a weighted average NPV. This is the NPV when these are the cash flows. But because these are estimated numbers, the numbers can change slightly here and there. So I'll change the numbers a little bit, get the new NPVs. So I will try to compute the weighted NPV for the project. And this is primarily giving me whether I should accept this project or not. And of course, I have to look at the risk tolerance. What is the bearable risk? To what extent I think this particular project what is the amount of risk that needs to be considered for this particular project. Based on that, we are trying to alter the different discount rates and trying to see the NPV in all the possible situations. So that's how the NPV is a very powerful tool in helping me take a decision with respect to the investment in a particular project, whether it is really worthy to invest in a particular project or not. Then comes the other mechanism, the second most important tool for evaluating the worthiness of the project, which is the internal rate of return. Even here also we go with a similar mechanism. So we talk about the cash flow at the end of first period discounted by R, cash flow at the end of the second period discounted by 1 plus R squared, cash flow at the end of the nth period I discount it by 1 plus R to the power n. The process is the same, just like your NPV computation, but the only difference is now I will not compute the NPV, or probably the R we said it was actually the cost of capital, but now I will not use the R as the cost of capital. Now R is a variable for me. Why I am calling it as a variable? This summation, which is the NPV that I get, I am setting it explicitly equal to 0, and whatever the R that can really set this NPV to 0, that R is what I am calling it as an internal rate of return, or IRR in short. So I am not discounting the cash flows at the cost of capital. I am trying to find a value of R where the NPV is projected NPV is coming out to be 0. So it's more like a return. Probably it is looking like the return that is achieved by the project. On an annual basis, what is the return that is achieved by the project is what is given by the IRR. So because it's one single number which is the return, probably I can very much convince even the non-experts. Yes, this particular investment on an average is going to give you 12% every year. It's a very easy way to convince the non-financial people also, because that's the language which every investor is going to understand. So wherever I see that the IRR, the return on the project, is greater than the cost of capital, if the IRR is greater than the cost of capital, what we generally see is the NPV will be positive during that period. And whenever the NPV is positive, we have already said that it will increase the value to the shareholders, which means those kind of projects need to be undertaken by the company. So we can very well proceed with that particular project because it looks more and more profitable. But what we generally see in the real world is, see, as we have said, here it is that particular R which makes the NPV 0. In short, we are actually solving this equation for R, and R is an nth degree equation. So there is a possibility that there can be n different values. So because R is nothing but the root of this equation, and there is a possibility that it can have n different values, and some of them may be real, some of them may be imaginary. And what we are simply saying is, depending on the number of changes in sign, mathematically, depending on the number of changes in sign, basically, okay, the cash flow 0 is negative and cash flow 1 is positive, which means there is one change in sign. But if cash flow 2 becomes negative, means the expenses are more than the revenues, then there is a change of sign 2 times, which means for this particular equation, there is a possibility of 2 real values of R, maximum of 2 real values of R. It could be 1, it could be 0, it could be 2, but there is a possibility of 2, which means those 2 can become the IRR. Now this is where what we see with this approach is there is a possibility of multiple IRRs, or there is a possibility that the data does not have that there may not be any single IRR also, which means there is no way my NPV can become zero. It can always, for all interest rates, my NPV could be positive, or it might very well be possible that for all interest rates, my NPV could be negative. So there is no way it can move from positive to a negative, which means there is no IRR at all. Now that is what will create the limitation with respect to the usage of IRR. While for every kind of a project, we can very well define the NPV. In case of IRR, it is very much possible that there might be multiple IRRs, or in some cases there may not be any IRR as such. And on the other side, we have already said all these cash flows are estimates, and by changing the cash flows, we are computing the NPV in each of them, and after that I am doing a weighted average of all the NPVs. But I can't do a weighted average of all the IRRs. They don't follow that kind of a linear relationship. So I cannot change the different possibilities of the cash flows, take different IRRs and then take the weighted average of those IRRs. Even from that perspective, IRR is having a limitation. So because of these 2-3 limitations, what we generally see is, though there are lots and lots of usages of IRR, people still prefer NPV or net present value as the most powerful tool for evaluating a capital project rather than relying on the IRR. Then, apart from those two which are regarded as the best in class tools for evaluating the capital projects, we also see a few of them. One, the annual capital charge, wherein whatever is the total initial outlay, whatever is the invested amount, I am looking at it as an annual charge. Right? Based on the annual charge, I am expressing this entire capital outlay, and I am looking at writing it off against so every year that much of capital is getting written off, which means over a period the overall capital is getting written off. And wherever, which means it's as good as a kind of amortization. The whole capital is spread in some manner across the overall duration of the project, and that is where I am looking at the benefits. If they are still greater than the costs, I'll still accept the project, which means you could very well see the sensitivity in the very short term, because the interests are much higher in the short term, and even some portion of the principal also does come into picture. So what we could see is there's a lot of sensitivity in the short term, and it should not be ruled out just because NPV and IRR are there. Probably it can also be one of the mechanisms that can very well be used in terms of evaluating the project. But in the real world, very few instances of this being used. But yes, a very powerful tool I could see, almost at par with the NPV approach, is the shareholder value approach. Everything is same as NPV. Probably you can call it as an extension of the NPV approach also, because everything goes in line with the NPV approach itself. But the only difference is, or a much better difference also is, this R is not the cost of capital of the project. It has nothing to do with the financing of this particular project or the riskiness associated with this particular project. It looks at from the perspective of the shareholder. It's just not looking at a silo, isolated kind of an approach of only one single project. What is that? If at all this particular project is taken up by the company, what is the return that the shareholder is typically expecting out of this particular organization? So it is looking at from a broader perspective of a shareholder rather than focusing purely on the riskiness of the individual project. So it's a pure holistic approach, not just an incremental approach looking at one single project in isolation, which means internally it must be considering even the synergy that is associated with the project, how well this particular project really fits into the broader structure of the organization. All these things are considered in a very exhaustive manner, because we are looking at the total value of the company, because the NPV or the value that I am computing on a before and an after basis. Before taking up this project, what is the overall value of the firm? After undertaking this project, what is the overall value of the firm? The difference between these two is traditionally giving me the value of the project. So it is taking a holistic picture, which means the cash flows wise, I am trying to look at the cash flows which the project or which the company would have generated without this project, and I am discounting them with the rate of return without the taking of this project, and again the cash flows that would be generated after undertaking of this project with the risk or rate of return which the shareholder is expecting after the company takes up this project. So there are two values that are coming up. One is the value of the firm before taking up this project. Two is the value of the firm after taking up this project. The difference between these two is giving the value of the project through the shareholder value approach. And the process wise, yes, I'll take the price to earnings ratio or price to net asset ratio and try to take some competitors, even the ratio for those competitors, and finally I will see with respect to competitors whether the price of this company is already high or low. Whatever is the difference, that is purely associated with the additional price or additional value which the market has really placed on the management's ability to grow the business. The higher it is, probably the market capitalization is much high when comparison with the peers. Then what we are trying to look at is, now we are adding up the new project. And once we add up the new project, I am looking at what is the overall value of the firm. What is the impact? Now that difference, so any new project that we are bringing in, it's just not impacting the cash flows in isolation. There could be a lot of synergy related issues. So I have to evaluate in a very complete manner. Even the rating could get altered. Even the credit rating or even the positioning of the firm would get altered. And that would result in riskiness of the company as a whole growing. So this is what is the shareholders approach bringing to us. So whenever we are looking at from a shareholders approach perspective, okay, will taking up this project, will it change my competitive position? How are the competitors going to react to this? How would the competition level change? Right? How is the management decision taking perceived by the market? How will all the analysts, the market analysts, perceive the growth of the firm? What would happen to the credit rating of the firm? What will happen to the earnings? Will it be enhanced or will they be diluted? Will it have any kind of an impact on the dividend policy? Will it have any kind of impact on the riskiness of the firm as measured by the beta? All these things need to be considered while deriving the value of the firm after taking up this particular project. It's a very, very complex process. Probably I need to have a proper mathematical modeling for the same, because I have to look at various interactions and feedbacks. So from an actuarial perspective, probably there is a lot of work that can be done in this particular valuation mechanism. And this is a mechanism that gives the management a clear sight to adopt exciting new policies which are very well received by the market. So probably one of the best approaches, but it's a very complicated and difficult to implement kind of approaches. Then one of the most simplest mechanism that is being adopted to evaluate the capital project is the payback period. It's purely I have invested $1,000 today. Okay, in first year I am getting 200, in the second year I am getting 300, 700, and in the third year I am getting, let's say, 400. Now how much time on an average I am taking to get back my initial cash? Probably 200, 900, and just 1 by 400. So probably 2.25 years, because at the end of 2 years I am getting my 900, but at the end of the 3 years I am getting 1300, where I really need to get only 1000, which means even if I get 100 in the third year, I would be I would recover all my investment. So if 400 is coming in the whole of the year, 100 comes in 1/4 of the year. So overall we'll say that the payback period is around 2.25 years. So the time it takes for the accumulated cash flows to become neutral. The cash outflow without any kind of a discounting, without considering the time value of money, the cash outflow should be equal to the cash inflow. So it's purely based on cash flow itself, no discounting, no risk being considered, right? The speed at which the project can really get back its initial investment. So this is generally being taken up by those companies which are very small right now, which are growing very fast. They find it very difficult to raise any kind of loans, or even if the shareholders are already oversaturated. For those firms, rather than looking at NPV or IRR kind of approaches, probably the payback period where they can recover their initial investment is a very crucial aspect. So the more and more faster I am able to get back my initial investment, I would prefer that kind of a project rather than something which comes on a heavy amount at a much later point in time. So it is primarily helpful in terms of identifying those projects which generate the most amount of funds, large amount of funds in a specific time period. So, but the only major drawback of this is it does not take into consideration the discounting aspect. Then one more mechanism that is available or helpful for us is the nominal returns. Simple. Cash generated to cash consumed. It's purely a cash based stuff. How much cash in a particular year or any time period, how much of cash, it's not revenue by expense, it's cash generated by cash consumed, real cash flow movement during a particular period. So on a broad scale, it can give me the relative profitability of the project, right? And if it is much higher, as long as it is much higher, it looks more and more profitable. But the only thing is, generally this is much preferred over a very short term period, because over a longer term there is a very high possibility of using a very heavy capital investment, and probably heavy capital investments can even pull down the ratio quite drastically. So this nominal returns approach is very much appropriate in the short term itself. But whatever are the mechanisms that we have looked at till now, they are more and more financial in nature, where the cash flows, some kind of calculation on the cash flows are being considered. Whereas this mechanism, which is a strategic fit, probably it needs to be packaged with every other mechanism that I have discussed till now. Because it's not looking at the evaluation of the project from a number perspective. It's more and more in terms of the logical fitment of the project, right? So purely it is from a strategic dimension. So, okay, is it really appropriate to get into this particular project with the kind of expertise that I have, that my organization has? What is the kind of experience that my resources typically have? What is the kind of expertise that they have? And is this project really appropriate, or will I be really successful by taking up this project given this is the quality of resources that I have? Given this kind of customer base, would it be worth for me to get into this kind of a project? It's purely looking at from a strategic fitment perspective. Because in some cases there are decisions that are taken that you better diversify into completely different set of industry. Is there any financial angle in that? There might be, but more than a financial angle, there is a strategic fitment angle that comes into it. So what we suggested is this kind of mechanism should be used more or less in parallel with other financial evaluation mechanisms. And based on the decision that you have taken, if the decision goes in your favor, there is a good chance for the investment that you have made to reap huge profit because you are one of the initial movers in that particular project. So as predicted, if the future is going to be, then huge opportunities are going to be opened up and there is an extraordinary chance of generating huge profits. But if things don't work out, there should be a mechanism even to minimize the potential downside also. All these things go as a part of a strategic fitment exercise. So the final mantra is do the right thing. And if you are doing the right thing, the required return comes as a byproduct and it's not the deciding factor. Probably an extraordinary thing to be remembered. If a business does the right thing, the required return comes as a byproduct and it is not the deciding factor. Right? So that is what goes as a part of understanding the strategic fitment exercise. Then the other mechanism that is typically looked at is the opportunity cost, which focuses purely on the alternative ways. It's not a new thing. Right? Don't restrict yourself only to one project. Think what are alternatives are there. What are the costs and benefits that are associated with each of the alternatives? Whatever is the capital do I have? In which of these projects it is best to invest? Which ones, how much money I can spend so that my overall return objectives are met along with the implied risk that I am taking. So it is purely focusing on the alternatives, the benefits as well as the negatives and positives that are associated with the different alternatives. The intention is purely identify an alternate opportunity which is much better, which I did not consider till late. That is what is an opportunity cost analysis. It helps me in terms of understanding the alternatives better. Even there is a possibility, okay, even if I have surplus capital, I don't want to invest in my business because it will not generate the required return. So just spend it. Right? Whether I should spend as an investment in my business this year or should I hold it in the form of cash will very clearly be justified using this opportunity cost approach. Right? You keep investing in the project as long as you feel that this project gives me the best possible return when I am evaluating it in combination with the various alternatives that are there. Similar projects which are having similar kind of risk profile, if I evaluate my project in comparison with all the other projects, what is the kind of benefit that my project is finally generating? There could even be a consideration of why don't you return the capital to the shareholders? Yes, it can be done. If there is a surplus capital, even this can be done. But sometimes the problem comes with the friction cost. Probably if the company wants to raise new capital next year, it may have to undergo all the flotation costs and everything. If it finds difficult raising cash next year, probably the growth is hampered. So that's the reason internally the company may decide in terms of holding something in the form of investments rather than distributing the cash to the shareholders. Now looking at another mechanism which is a hurdle rate. Probably in the NPV approach, we have decided cost of capital, which we said it is the weighted average cost of capital. Now the hurdle rate is a target. Might be much bigger than the cost of capital. Right? So I want to take up those projects only where the NPV is positive even after I discount it with the hurdle rate. That's the only difference. Or I want in my IRR also we have made a decision, as long as the IRR is greater than the cost of capital, I accept the project. But now we say in case of a hurdle rate, I say as long as the IRR is greater than the hurdle rate, accept the project, which means we are increasing the expectations. Right? We are making sure that we are taking only the most profitable projects, not each and every project. Sometimes it is very possible when the economy is doing well, when the alternatives, choice of the alternatives is very large, probably this mechanism is fine, but otherwise I may end up taking up not even a single project. So it's purely based on the target return that is set by the company. Sometimes it may be set very, very high, probably much higher than the long term equity returns also. So this will really bring out only high potential projects, and obviously it will help me in terms of if I am able to manage those high potential projects, probably the returns that I can generate out of them are going to be significantly high. But at the same time, I may miss out on various excellent low risk projects which can give returns which are higher than the cost of capital, but they will not cross the hurdle rate. Probably any projects whose returns are lying between the cost of capital and the hurdle rate, even the risk is much lesser, still I might end up not choosing those kind of projects and I may miss out executing those kind of projects. But whichever are the ones really highly crossing that hurdle rate mark, which are highly profitable kind of projects, even though they are highly risky, I'll end up taking up those kind of projects. And one more mechanism that goes in this context is a very simple one, the receipts to cost ratio. This is purely an financial statements based or profit and loss statement based computation. I look at gross revenues, gross expenses, capital and running costs, which are the expenses. I look at it as a proportion of the, I look at this as a profitability as a proportion of the costs, and every time this ratio is greater than 1, probably my revenues are always growing more and more higher compared to the expenses. But what we see there, here the problem that comes out is there is a possibility of lot of manipulation of the financial statement, because majority of the financial statements, they go with some kind of reporting standards like IFRS, and where there is a lot of flexibility in terms of the presentation of the financial statement. So which means some kind of loopholes can be tweaked in, some kind of workarounds can be tweaked in, manipulated to keep the results on the higher side. So these are the various mechanisms that are available to us when it goes with evaluating the capital projects, different ways of evaluating the capital projects, right?